Hello, everyone, and welcome back to the channel. Before we jump in, if you're interested in Canadian dividend stocks and building wealth through smart investing insights like these, make sure you subscribe right now and hit that notification bell so you don't miss out on future videos. Are you looking for ways to build reliable, growing income from your investments, especially as we look ahead into 2025? If so, you're in the right place. Today, we're diving deep into the Canadian stock market to uncover 5 top-tier dividend growth stocks that could form a solid foundation for your portfolio. Now, why focus on dividend growth? While high initial yields can be tempting, chasing them can sometimes lead you into dividend traps, companies struggling financially that might cut their payouts later. True long term income security often comes from companies that not only pay dividends but consistently increase them year after year. This signals financial health, strong management, and confidence in the future. And Canada is a fantastic place for this strategy. Did you know that since 1956, dividends have contributed roughly 30% of the total return of the S&P/TSX Composite Index? That's significant. But the Canadian market is heavily concentrated in sectors like financials, energy, and materials. Relying only on the biggest names can leave your portfolio unbalanced. That's why today we're focusing on a diversified approach. We've identified 5 dividend growth champions, each from a different core GX sector based on strict criteria. At least 10 consecutive years of dividend increases, positive dividend growth rates with a minimum 5 year average growth of 3%, sustainable payout ratios based on earnings and cash flow, and overall solid financial health. Ready to meet our top 5 for 2025? Let's dive in. First up, from the crucial financial sector, we have the Royal Bank of Canada, ticker RY.TO. As Canada's largest bank by market cap, RBC is a cornerstone of the Canadian economy with significant operations both domestically and internationally, especially in the US. When it comes to dividends, RBC has a strong track record, boasting 15 consecutive years of dividend increases. Their growth rate is solid too, with a 5 year compound annual growth rate CAGR around 6.6% and a 10-year CAGR near 6.9%. As of late April 2025, the forward dividend yield is sitting around 3.6%. Now, is it sustainable? RBC targets an earnings payout ratio between 40 and 50%, and they're right in that sweet spot, recently around 46 to 50%. This means the dividend is well covered by profits. Financially, RBC is robust. Their key capital metric, the Common Equity Tier 1 or CET1 ratio, was a strong 13.2% in the first quarter of 2025, well above regulatory minimums. This provides a solid cushion. Looking ahead to 2025, the outlook for Canadian banks is generally stable. Potential interest rate cuts could boost loan demand, but risks remain, particularly around potential US trade tariffs impacting the Canadian economy and potential increases in credit losses. RBC's large scale and diversified business offers significant resilience. RBC offers a blend of reliable dividend growth from a market leader in a core sector backed by strong capital levels. It's a solid anchor for many dividend portfolios. Moving into the utilities sector, our second pick is Fortis Inc., ticker FTS.TO. Fortis is a major regulated electric and gas utility holding company operating across Canada, the US, and the Caribbean. The key word here is regulated. This provides highly predictable cash flows, which is exactly what you want for dividend stability. And Fortis delivers stability in spades. They have an incredible 51 consecutive years of dividend increases. That's one of the longest streaks in Canada. Fortis isn't just maintaining its dividend, it's growing it reliably. They are targeting 4 to 6% annual dividend growth through 2029, supported by massive investments in their regulated assets. Their historical 5 year and 10-year CAGRs are around 5.5% and 6.4% respectively. The current yield is attractive, around 3.6 to 3.9%. Sustainability: for utilities, the EPS payout ratio is often higher, and Fortis sits around 73 to 74% based on adjusted earnings, which is typical for the sector. More importantly, their dividend growth guidance is directly linked to planned earnings growth from expanding their regulated rate base. A $26 billion capital plan fuels this confidence. Financially, Fortis maintains investment-grade credit ratings. While they carry significant debt, typical for utilities with debt to capital around 56%, it's managed within regulatory frameworks and supported by those stable cash flows. Their 2025 outlook is stable, driven by investments needed for grid modernization and the energy transition. Risks include regulatory decisions on rates and executing their large capital plan. Fortis is the definition of a blue chip dividend grower. That 51-year streak and clear future growth path make it a core holding for conservative income investors seeking reliable, growing payouts from the stable utility sector. Next, we head to the energy sector with Enbridge Inc., ticker ENB.TO. Enbridge is a giant in North American energy infrastructure. They operate vital liquids pipelines, extensive natural gas networks, a massive gas utility business, now the largest in North America by volume, and a growing renewables portfolio. This diversification within energy is key. Enbridge also boasts an impressive dividend track record, 30 consecutive years of increases. Historically, growth was very strong, with a 10-year CAGR around 10.1%. It has moderated recently, with the 5-year CAGR around 4.4% and the latest increase at 3.0%. However, Enbridge offers the highest yield on our list today, currently around 5.8%. Now, sustainability for companies like Enbridge requires looking beyond earnings per share. Their EPS payout ratio is often over 100% due to high depreciation charges and isn't meaningful. The critical metric is distributable cash flow, DCF. Enbridge targets paying out 60 to 70% of its DCF as dividends, and management indicates they expect to remain within this sustainable range. This is the number to watch. Financially, Enbridge generates massive predictable cash flow thanks to long-term contracts. About 98% of its business is contracted. They manage significant debt, typical for the industry, targeting a debt to EBITDA ratio between 4.5x and 5.0x to maintain their investment grade ratings. The 2025 outlook involves navigating the energy transition. While long-term pressures exist for oil, near-term infrastructure demand remains strong, especially for natural gas and LNG exports. Risks include regulatory hurdles for new projects and potential impacts from US tariffs. Enbridge's diversification helps mitigate some of these risks. Enbridge provides a high current yield backed by a long growth streak and predictable cash flows from essential infrastructure. If you understand the importance of the DCF payout ratio and are comfortable with the energy sector's dynamics, ENB offers compelling income potential. Shifting gears to the industrial sector, we have the Canadian National Railway Company, ticker CNR.TO. CN Rail is a powerhouse in the North American supply chain. Operating a vast network across Canada and Mid-America connecting 3 coasts, it's essential for transporting everything from raw materials to finished goods. This dominant position provides a strong competitive moat. CN has an outstanding dividend growth record, 29 consecutive years of increases ever since its privatization in 1995. The growth rate has been impressive, with a 10-year CAGR around 12.5 to 13% and a 5-year CAGR between 9.3 and 11.1%. The most recent increase was 5%. Reflecting its growth profile, the current yield is lower, around 2.5 to 2.7%. Sustainability is a strong point here. CN maintains a very conservative EPS payout ratio, typically well below 50%, recently around 48%. This leaves plenty of room for future increases, reinvestment in the business, and share buybacks. Their free cash flow generation is also strong, reported at $3.1 billion in 2024, comfortably supporting dividends and growth initiatives. CN maintains a strong balance sheet, managing its debt prudently. Looking to 2025, performance is tied to economic activity and trade volumes. Key risks include economic slowdowns and, significantly for CN, with its extensive cross border traffic, potential US trade tariffs disrupting freight volumes. CN Rail offers high quality exposure to the industrial backbone of North America. Its long dividend growth streak, very safe payout ratio, and dominant market position make it attractive, though investors should be aware of its sensitivity to economic cycles and trade policies. Finally, rounding out our list in the defensive consumer staples sector is Metro Inc., ticker MRU. Metro is a leading Canadian food and pharmacy retailer, primarily operating grocery stores like Metro and Food Basics, and pharmacies like Jean Coutu and Brunet, mainly in Quebec and Ontario. Selling essential goods makes this a defensive play, often holding up better during economic uncertainty. Metro matches Enbridge with 30 consecutive years of dividend increases, another impressive streak, and the growth rate is strong. The 10-year CAGR is about 10.5%, and the 5-year CAGR is around 11%. The most recent hike was over 10%. The current yield is the lowest on our list, around 1.4 to 1.5%, reflecting its defensive quality and growth focus. Dividend safety is exceptional here. Metro targets an EPS payout ratio between 30 and 40% of adjusted net earnings, and it's currently right in the low end of that range, around 31 to 33%. This is extremely conservative and indicates a very secure dividend with ample room for growth, reinvestment, and share buybacks. Metro maintains a healthy balance sheet with relatively low debt. Debt to equity around 42% based on recent figures. The 2025 outlook for grocers is stable due to the essential nature of their business, but they face headwinds from intense competition, high food inflation pressuring consumers, and again, the significant risk of potential US tariffs disrupting supply chains and raising costs. Metro offers exceptional dividend safety and strong growth from a defensive sector. While the yield is lower, its consistency, very low payout ratio, and resilience make it an attractive option for investors prioritizing stability and long-term dividend growth, even amidst potential economic challenges. So let's quickly recap and compare these five fantastic Canadian dividend growers. As you can see, we have a diverse group. Fortis, FTS.TO leads with an incredible 51-year streak. Enbridge, ENB.TO, offers the highest current yield at around 5.8% but requires monitoring its DCF payout. CN Rail, CNR.TO, and Metro MRU.TO have shown faster recent dividend growth rates and boast very conservative payout ratios, though their starting yields are lower. Royal Bank, RY.TO, provides a solid blend from the vital financial sector with a strong capital base. This diversification across financials, utilities, energy, industrials, and consumer staples gives you exposure to different economic drivers and helps mitigate sector specific risks. These five companies, Royal Bank, Fortis, Enbridge, CN Rail, and Metro, represent compelling opportunities for Canadian dividend growth investors looking towards 2025. They each have long track records, generally sustainable payouts, strong market positions, and operate in core sectors. However, investing always involves risk. Keep a close eye on the broader economy, interest rate movements, and especially the potential impact of US trade policies and tariffs. This was a recurring risk mentioned across multiple sectors for 2025. Also, monitor company specific performance through their quarterly reports. Remember, this video is for informational purposes only and is a starting point. Always do your own research and consider your individual financial situation and risk tolerance before making any investment decisions. Which of these stocks interests you the most? Do you own any of them already? Let me know down in the comments below. If you found this analysis helpful, please give this video a thumbs up. It really helps the channel. And if you haven't already, hit that subscribe button and ring the bell so you don't miss our future deep dives into Canadian investing opportunities. Thanks so much for watching. Invest wisely, stay informed, and I'll see you in the next video.